Good afternoon, everyone. Welcome to our webinar for October month. We've had quite an interesting month. If you look at the chart on your screen, you'll see that the S&P 500 is doing more or less what we thought it would do. If we go to this point up here, if I put a horizontal line there at the record high, it's quite interesting to analyze what happened here. You can see that there was a clear break up and then it came back to that level of 2872 and bounced off it. In other words, what was previously the resistance became the support, and you had a bounce off it, and now, of course, a month later we are quite strongly up from that point, and I think there's no doubt that the correction which went on for 7 months is now over, and we're now moving into a new area. So we can also possibly look at the fact that the trend appears to be steepening. I'm just going to put another line here for you. So that shows how we've got a rising trend and we're sort of breaking out of this channel on the upside. As you can see also, the 300-day moving average continues to rise steadily. Of course, the S&P 500 is the 500 largest companies trading on Wall Street, and those companies are rising because they're making better profits, and those better profits are caused or initiated by the very stimulatory monetary policy which the US has had for the last 10 years. And so it's got far more to do with that monetary policy stance than anything that Donald Trump is doing or done. I mean, he has cut corporate tax, I'm aware of that, but I think the real power behind this bull trend is, as it has always been, the quantitative easing and the very low interest rates which have existed in America since the subprime crisis in 2008. So we're in a bull trend, and the world markets, stock markets of the world, will follow Wall Street up sooner or later, including the JSE, of course. So now, if we look at South Africa, what's going on here, the way it's evolving, it's like a battleground between good and evil, you could say, and it's got all the characteristics of Game of Thrones or Harry Potter, the good guys and the bad guys. And many preliminary battles have been won by the good guys. And here I'm talking about Mr. Ramaphosa, President Ramaphosa, and people like Pravin Gordhan and Trevor Manuel and others, Minister Nene. These people are winning battles virtually every week. But it's going to take time for the damage that was done by the Zuma-Gupta period to be unwound and for things to be put straight again. And I think that the real turning point will be the election. So the election next year, which President Ramaphosa has brought earlier before the end of May next year, will be a turning point, because obviously Ramaphosa needs a mandate from the democracy in order to undertake some of the more difficult reforms which I think he has to engage with. And then, of course, at the same time, there have been some quite serious outside forces which have come into play during the last month, particularly the trouble in Turkey and then also in Argentina. And those things have impacted on South Africa. And those are outside forces. There's not much we can do about them. Also, the things which Donald Trump has been saying, which have caused a sort of international trade war, that also impacts on South Africa as an emerging market. And all these things are discounted into the rand dollar chart. So if you want to know what's really going on in South Africa and how overseas investors are perceiving this country, you need to look at that rand dollar chart. That is the benchmark. On the political side, the Institute of Race Relations did a survey recently. They surveyed about just under 1,000 people, and they found that 50% of those people support the ANC, 13% support the EFF, and 23% support the DA. So this would tend to indicate that since the municipal elections in 2016, the ANC have lost some ground, because in those elections they got 54%. Now they're down to 50%. At the same time, the EFF, which previously got 8%, is now up to 13%, and the DA is staying more or less in the same place. I might add, though, that as soon as this survey result came out, the DA pointed out that they have won more than 50% of the by-elections. So that would be an indication that perhaps this survey is not 100% correct. They reckon that their support is much stronger than that. Of course, the big factor in this election is not the land redistribution issue. It's that is making all the headlines. But the really big factor, as far as most voters are concerned, is unemployment and service delivery. These two issues are the most important issues for the South African voter at the moment. So obviously Ramaphosa is doing his very best to try and improve those issues, but the things that he's doing will not come through. They will not impact on the average person living in a squatter camp before the election. That's my opinion. That they are moves which will certainly improve things over time, and it's going to take several years. But progress is being made. I mean, I see that Mr. Gama has been fired from Eskom now by the board, and in fact it's even being suggested that he might have to pay back 151 million rand, which he authorized when he was the CEO, and which Transnet paid, and which they now say he owes to them. And his two acolytes, Giuliani and Mdletshe, were also suspended from the board. All three are implicated in the 54 billion rand train contract, which Transnet was involved in. So obviously the Transnet board is now in a position to perform well without these three in the boardroom. The new mining charter is a major step forward. It's perhaps not as investor friendly as we would have liked, but in three respects it is better than the previous draft. The first one is that the 5% which was to be given to the community, the 5% of mining companies which was to be given to the community, can now be invested directly. In other words, the value of that can be invested directly into the community without releasing that shareholding. The 1% trickle-down dividend, which was to be paid whether or not the company made a profit, can now be paid at the discretion of the directors when they pay other dividends. So they again now have control over that, which is a big improvement from their perspective. And then thirdly, the increase in the black shareholding from 26% to 30% is now only going to apply to new mining rights. So those companies that already have their 26% do not need to change that unless they try to go for a new mining right, and that new mining right will have to have 30%. So these are quite big concessions which will make the charter more acceptable. Still, however, quite investment unfriendly, if I can put it that way. At the same time, our Minister of Minerals and Mining has said that the Mineral Resources and Petroleum Amendment Bill will be abandoned, and he is going to use the old bill for mines and will produce a completely new bill for the oil and gas industry. So that's also a big benefit. He also did another thing which is a move in the right direction. When he closed the Mpumalanga mining office, that was known to be a center of corruption and maladministration and nepotism. So closing it has helped quite a bit. So there are moves in the right direction. Whether they will impact on investment in the mining industry in the short term, I'm not so sure. I think it will take a little time. The economy generally is in a bad place. Since I last spoke to you, we've entered a technical recession. That's 2 quarters of negative GDP growth. So that shows that the damage which was wrought by the Zuma era, was deeper and worse than we thought. GDP, gross domestic product, was much lower than expected. The Reserve Bank is only expecting GDP growth this year of 0.7% now. And obviously this is in part caused by the land expropriation issue, and that has shown an effect in land prices, in farm prices and small holding prices, which have fallen by 30%. So land and small holding prices have fallen by 30% because of all the talk around expropriation without compensation. Manufacturing has been very depressed over the second quarter, shedding a great deal of jobs. But I do think that we are looking at a situation where it is, how can we say, darkest before dawn. We're at the worst point. The second quarter of 2018, when we look back on it, may well turn out to be the bottom of this negative trend. Ramaphosa's new plan to stimulate the economy is not an injection of cash, rather it's a reallocation of budgets and the removal or elimination of various forms of bureaucratic red tape. For example, the whole issue with tourism and the visas. The visa regulations are being changed to make them more tourist friendly, and obviously that can help a lot in that industry, which is a very important industry in South Africa and impacts a lot of employment in this country. And also the infrastructure fund, which is going to be partly financed by government, partly financed by the private sector. That will tackle communications and transport infrastructure in this country, which we desperately need. And it will upgrade the 26 industrial parks which exist in South Africa. Of course, during the month past, we also had this capping of the petrol price last month in September, where the government only allowed the petrol price to go up by 5% and paid the difference. So they had to fork out 575 million in a once-off payment to try and keep the petrol price lower in September. The problem with this is that it basically means that petrol price increase will come through in October. The government cannot afford to keep subsidizing the petrol price. And Azar Jamin, the economist, said that what they did there was, to quote him, illogical and dangerous. The oil price has gone up above $80 a barrel, upside breakout. So if I can just show you that on the chart, you'll see what I'm talking about. All right, just put 5 years on the screen here. Here you can see the price of North Sea Brent oil. This is the collapse of oil, this fall here in the second half of 2014, which saw the oil price go all the way down to $28 a barrel in January 2016. Since then, it's been trending upwards and reached this $80 resistance level. And as you can see over here, it recently broke up through that $80 level, which indicates that the world economy is recovering, the demand for oil is going up, and that is what is causing the price to rise. Obviously, this is not good for the South African petrol price, especially if it's accompanied by a fall in the rand. So much depends on the rand-dollar exchange rate, and that's where you should really pay attention. But it does reflect the fact that the world economy is in a strong recovery, led by America. The other countries of the world, particularly Europe and China, are being pulled up by the American economy, and the American economy is going like an absolute train. That's why the S&P 500 is breaking to new record highs all the time. Moody's has decided to keep the South African rating on a stable outlook. This is really good news for us. On the 12th of October, in just a few days' time, they will make a decision on our rating. But I'm hoping and I'm fairly certain that they will retain our investment grade rating. And that's a good thing, because if they didn't retain it, roughly 100 billion rand would leave the country, and you could imagine the impact that that would have on the rand in the short term, and therefore on the petrol price and inflation, etc., etc. One of the interesting things about our economy, Weber Wenzel came out with a report recently in which they estimated that 9 million people in South Africa, 9 million people in South Africa have lost their livelihood over the last 15 years in the mining industry. That's an extraordinary number. It shows how the economy has shifted. This economy, which used to be dominated by mining has ceased to be a major force in our economy, and every year it's becoming a smaller and smaller factor in the economy. Okay, let's have a look at the rand, because as I've said, it's a very important indicator and we really need to pay attention to it. Okay, so I've drawn a chart here. You're probably familiar with my upper and lower channel lines. Remember, the rand was in this channel for a long time, ever since Nene was fired as the Minister of Finance and then Pravin Gordhan was appointed. It entered into this stronger channel, and it eventually reached a very strong point down here at around 1150, and then it started to weaken. Now, it weakened back to this upper channel line and then started a new strengthening trend, and then suddenly we had this trouble overseas, starting in Turkey and then spreading to Argentina, and Donald Trump stepping in and applying sanctions to Russia. All these things made emerging markets far less palatable to international investors. We went from risk on to risk off, and we did it very quickly. The rand reflected this change quite dramatically, but not nearly as dramatically as other emerging market currencies. And here you can see this huge pattern here, which developed as a result. And the rand actually reached 15 Rand 70 to the US dollar. But since then, it's been strengthening quite sharply. And although we're now over here at about just over 14 Rand to the US dollar, what we need to see is this rand come all the way back down to around 1330 or 1340 to the US dollar. So we're not out of the woods yet. As you can see, this weakening trend, which I've drawn in over here, is still intact. We need to break below that, and if possible, break back into the channel before we can say that this formation over here is an aberration, a technical aberration. Right now, the trend is still negative, even though we've had a considerable period of strength and the rand is back down to 1415 to 1417. All right, let's look at a few general points. I noticed that in Zimbabwe they're desperately short of foreign currency, and this is causing food shortages, and there's a black market in food and rising prices there. The situation has been obviously made worse by South Africa's technical recession. A lot of Zimbabweans work here, and then they remit their salaries back to Zimbabwe to feed their families. And obviously, if the work situation here is desperate, which I think it is, less Zimbabweans are going to find work, which means less money is going to go back to Zimbabwe. Both countries, of course, have new presidents. Both are trying to recover from the damage of the past. Both have rising levels of civil disturbance, and they have rising levels of poverty and unemployment. And both economies are driven by commodities. That is their primary export. And so they're being negatively affected by the poor price of commodities, particularly precious metals. But the South African economy is at least 20 times the size of the Zimbabwean economy. And it has its own currency, which is stable and is independent. The currency is independently managed by an independent reserve bank. That strength of our currency has been South Africa's saving grace. That, together with a professional and independent judiciary, have kept this country together during the difficult Zuma years. So Zimbabwe is a very interesting case, and one which South African leaders should study, because we clearly don't want to go down that path. We don't want to go down that path as far as debasing our currency is concerned, and we don't want to go down that path as far as allowing land grabs is concerned. The economic consequences of these kind of populist moves are devastating. On a different subject, the A2X, which is the most significant competitor to the JSE of the various stock exchanges that registered and were licensed last year, The A2X is the one which really is going to compete with the JSE. And the A2X has taken on its 11th listing now in the form of Signia. And Signia is an asset management company, and it will bring to the A2X all its ETFs, all its exchange traded funds. So as soon as the A2X has a license to trade ETFs, they will obviously be trading the Signia ETFs. That's quite a big change over there. The point about the A2X is that its dealing costs are roughly 50%, up to 50% cheaper than those of the JSE. And that can only be a benefit to private investors. The JSE has had a monopoly on share trading for far too long. And this is a healthy competition that we are looking at here. Now, I noticed that there's been some move in this country towards legalizing marijuana. And this drug is now, you can smoke marijuana in your home if you want to, and grow marijuana for your own use. Of course, overseas, this move towards legalizing marijuana has gained a lot of momentum, particularly in Canada. And there are huge investments now into the growing and marketing and selling of marijuana overseas. And as I said, Canada is right at the forefront of this. And there are a lot of companies that are coming onto the Canadian Stock Exchange, and they are doing well. There's a lot of excitement around this new market. I mean, nobody really knows how big the marijuana market could be if it's legalized. It should certainly be as big as the alcohol market, one would think. And then there's the potential to add marijuana to all sorts of different foods and drinks once it is legalized. So potentially a major disruption in the industrial world, starting with a new product. And it's not a technical disruption, for a change. Usually disruptions in the modern world are caused by new technology, but not in this case. Anyway, there's nothing you can invest in at the moment on the JSE which is going to give you exposure to this new market. But I guess that there will be in due course. Now let's turn our attention to some of the companies. I want to talk a little bit about African exposure. A little while back, 3 or 4 years ago, it was very popular in South Africa for listed companies listed on the JSE, to open branches and set up operations in African countries to the north. And it was something that everybody was very proud of once they achieved it, and they talked about it in their annual financial statements. But over the last year or so, that African exposure has become a major negative, mainly because countries to the north of us are not well run, they are erratic, they are unpredictable. And this is perhaps best seen in the case of MTN, where they originally paid just over $1 billion fine to the Nigerian government, and now suddenly the Nigerian government has slapped a new order on them, requiring them to return $8.1 billion of dividends to Nigeria, and at the same time they simply took 75 million rand out of Standard Bank's account as a fine for colluding with MTN in taking these dividends out of the country in a manner which they said was illegal. Of course, they just took that money without due process. In other words, they didn't allow Standard Bank to give their side of the story and argue against this fine. They just took the money. Obviously, that's not good for Nigeria. That will impact foreign direct investment in Nigeria, because what investor is going to put their money into a country where the Reserve Bank can just step in and take the money out of their bank account without any process of any description at all? And then, of course, we've got the inflation situation in Angola, which has hammered ShopRite. I spoke about that in our last report. So generally speaking, investors are now looking at companies listed on the JSE and asking what is their African exposure. And they view that with some trepidation, because African governments are proving to be erratic and uncontrolled, and they're not behaving in a normal manner as a government should. Right, the next thing I want to draw your attention to now we're talking about companies is what I call the diagonals. These are shares which have a very long track record of producing profits. The reason I call them diagonals is because their share price goes from the bottom left-hand corner of the screen to the top right-hand corner of the screen over the long term. So, I mean, here, let's take a look at a share like Santam. I'm just going to put it on the screen here quickly. Right, there's Santam. I want to put everything there. And as you can see, this is a chart which goes all the way back to 1985, February 1985. So what we're looking at here is 33 years of history of Santam. It's a logarithmic chart. And as you can see, the share price has moved roughly in the same direction as this line here, this diagonal line, which goes from the bottom left-hand corner of the screen to the top right-hand corner. That's why I call shares like this diagonals, because they have this characteristic. And remember that this 33 years incorporates the 1987 crash, the dot-com crash of 1998, the 2008 subprime crisis. It includes the Gupta-Zuma years. It includes all those things, and yet this company, Santam, has consistently shown that it grows through thick and thin. It is an incredibly defensive share that over the long term produces great results. And in fact, those great results were shown once again in its interim figures for the period, the 6 months to the 30th of June this year. It increased its gross premiums by 9%, and its underwriting premium to 8.4%, which resulted in headline earnings per share going up a massive 72%. So this is one of the best charts on the JSE. Santam is now trading on a PE of 21 and a dividend yield of 2.5%. And I think that it's a share which should be part of every private investor's portfolio, because it has shown time and again that it has the ability to keep growing no matter what the economy around it is doing. So Santam is a short-term insurer. It doesn't do what's called endowment or long-term insurance. There's no investment insurance in Santam. It is purely short-term. So they will insure your life. They'll insure you against any disability that you may get. They will insure your house, your motor car, your farm. They'll insure your business's profits and so forth. They are short-term. But there's always business for them in this country. And they are South Africa's biggest short-term insurer. Another diagonal share is Angloval Industries. This is a producer of general consumer goods. So they've got a lot of very well-known brands that I'm sure you're familiar with. Brands like Salty Cracks, Frisco Coffee, Provita, Yardley. They produce a whole range of consumer goods. And you can see here, let me just put all the data on the screen. I think it's going to be too much. But for the last 20 years, this company, wait a minute, sorry, I'm doing the wrong thing here. What I wanted was, I want the zoom and I want the zoom box. And I want to just take it from there. The last 20 years, this is what I want to look at. And here again, you can see why I call this share a diagonal. Over the last 20 years, this share has just gone consistently up. And remember, this is a company that is exposed to the South African consumer. But through recessions and booms and all the things that I talked about earlier, this company has just kept going up and up in price. So this year they paid a special dividend of 250 cents. Obviously, they were affected by the tough economic environment. But they managed to increase their headline earnings per share by 7%, and that was off a 2% or 1.9% increase in turnover, which shows that their efficiency and cost cutting was there. The next company that I want to talk about in this regard is Clicks, and that also to me is a diagonal. And again, you'll see why when I put the chart on the screen. Right, we go to the long-term chart here, and once again, just put that zoom box on and just show you this last piece here. Now, from 2003, this share has been a remarkable share, and it's been a diagonal. It keeps going up. It's recession-proof. It grows no matter what happens. They now have 824 stores. Obviously, that includes Musica, GNC, and the Body Shop, which are also subsidiaries of theirs. They've got over 500 pharmacies, which makes them the largest pharmacy chain in South Africa. In this particular period, in the 6 months to February this year, they increased their headline earnings per share by 14.8%. That's a fantastic growth. Their club card members, the Clicks Club Card members, increased by 950,000 to 7.5 million. Over the long term, that's back to 2003, this share price has gone up 2,500%. So all you needed to do was to buy this share in 2003 and hold it. Not only would you have got the 2,500%, you would have also got nice dividends on a regular basis. So this is what I mean by a diagonal. It's a share which you should have in your portfolio because it has demonstrated its ability to grow over the long term, more or less no matter what happens in the economy. Okay, let's look at a couple of property shares now. The first one I want to talk about is Raven, which listed on the JSE just on the 10th of this month, 10th of September. It was a secondary listing. It's already listed in London on the alternative investment market in London, the AIM. But what's interesting about this company is that they only have property in Russia. So it's an exposure to Russian properties. Half of its income is received in US dollars and half in Russian rubles. Now, obviously, the Russian economy is very much a commodity economy like the South African economy, only more so, because Russia is very much linked to the oil price. But the break above $80 a barrel in the oil price will positively impact on Russia. However, we think that Raven is very speculative. Okay, it's only got a 5 billion rand market cap, and obviously the properties which we are looking at here are in Russia. We know that Russia is regarded as an emerging market currency. America has just slapped sanctions on them. So maybe it's not the greatest property investment, but it's a new listing and I thought I should just talk about it. Then I'd like to just look at Hyprop. Now, Hyprop is, in contrast, one of the best property companies in South Africa. And as you can see over here, just going to put a bit more data on. Over the last year, well, since really this year, from the beginning of this year, the share price has come down quite a lot. And that's obviously because of the impact of what happened to the Resilient group of companies, where they collapsed basically at the beginning of this year. Now, that has affected all property companies, including Hyprop. But Hyprop is a great property company, and the reason I say that is because it owns high-end shopping malls all around South Africa. So, shopping malls that are well known to everyone, like Hyde Park Corner, Rosebank, Canal Walk, and so forth. In the most recent financials for the year to the 30th of June 2018, they showed a dividend growth of 9.3%, which is very good when you compare it to other property real estate investment trusts. They also did a rights issue where they raised 778.7 million rand by issuing 7.5 million new shares. So they're well capitalized. And the shares only fallen because of Resilient, in my opinion. And as you can see down here, at these levels around 92 rand, the share is actually below its net asset value. Its net asset value is 103 rand. And remember, those net assets are property in very, very high quality shopping centers. So I think they're very reliable. That 103 rand is a very reliable figure. And yet the share is trading for 92. I think it's a good buy, and I think that private investors who want to get a secure, very conservative investment would do worse than look at Hyprop. Then obviously I need to talk a little bit about Comair. Comair produced a great set of results with its biggest profit ever in its history, over 300 million rand, and they now have 72 years of continuous profitability. They've never been unprofitable since they started that business. And remember, Comair is in the tough business, in the airline business. They operate for British Airways, and they also obviously have the discount airline Kulula. The industry that they're in is distorted by SAA, but Comair is competing very effectively. The way they compete is by concentrating on cutting their costs and being more efficient. They've completely implemented a new fleet of aircraft which use 14% less fuel, and they carry more passengers. So they're carrying more passengers with less fuel. Fuel is the biggest cost in the airline business. And of course, Comair is our only listed airline. In the year to the 30th of June 2018, they showed a 4% increase in the number of passengers, and they were able to put their fares up, their fares for flying up by 3%. Non-airline business, which is mostly shops and retail at their airports and things like that, contributed 25% to their profits. But this company, which has been continuously profitable for 72 years, really shows that SAA is a complete waste of time. They should close it, sell it, get rid of it. SAA has come to Parliament with another demand for 21.4 billion rand. Will our financing of this organization ever stop? Because we have put so much money into it, and really it's proving to be unworthy of that support. I'd rather see a private company take over that position. Now I'd like to talk a little bit about unbundling, because there are a couple of opportunities coming up now in unbundling. From time to time, an investment holding company, which is listed on the JSE, will unbundle a division or a part. And that unbundling usually releases shareholder value. That's what it does. So the two separated entities become worth more than they were when they were joined. It releases shareholder value. And as a private investor, you can take advantage of that, and it's a really easy thing to do. The first example I'd like to talk about is Old Mutual. Old Mutual recently separately listed on the 26th of June this year as part of the major breakup of the Old Mutual Group. And it traded at around just under 30 Rand a share. And now they are going to unbundle their Nedbank shares. So they're going to basically take all the Nedbank shares which they hold and give them in proportion to their existing Old Mutual shareholders. So every Old Mutual shareholder, for every 100 shares they've got now, will get 3.5 Nedbank shares. Now, Nedbank is a great company trading at over 250 Rand per share. And then straight after that, on the 16th of October, they're going to pay out a 7.1 billion Rand dividend. The total value of these two things is 50.3 billion. So if you look at the market capitalization of Old Mutual as it is now, you'll see it's just under 150 billion Rand. So they're going to now give 50 billion Rand worth of unbundled things, shares and cash, to their existing shareholders. Now obviously that will cause the price of Old Mutual shares to fall, but I doubt if they fall by as much as the value which they're going to deliver to shareholders. So this is an opportunity. If you're a private investor, you could buy some Old Mutual shares, and then on the 15th you'll get your Nedbank shares, on the 16th you'll get your dividend, and you'll still own your Old Mutual shares, and obviously they will fall a bit in price to compensate for that, but I'm sure you will make money by doing that. The second opportunity in this regard is with Imperial. Imperial is a big company. It's got a turnover in the year to the 30th of June 2017 of 116 billion Rand. It operates in 33 European and African countries. Its trading statement indicated that headline earnings per share would be up between 9% and 16% in the 2018 year. Now what they are going to do is on the 22nd of November this year, they're going to separately list their Motors division. So then the company will be two different divisions. And obviously those shares in Motors will be issued to the existing shareholders of Imperial. So if you're holding Imperial shares on the 22nd of November, you will get an equivalent number of Motors shares. And we think that Imperial is pretty cheap at the current level. It's around 175 Rand and trading on a price earnings ratio of about 11. So I think it's cheap at that level, and you've got the potential to make a nice gain from the unbundling of Motors. Ladies and gentlemen, that's about all I've got for you today. I hope you enjoyed the presentation, and I look forward to talking to you again in about a month's time. Thank you.